Hello and welcome to the Trader to Trader podcast. I'm sorry that it took quite some time to release the next episode. I'm really happy to welcome Zoltan today. He's one of the few traders for a few years now. I'm very excited to have this discussion with him today. We have a number of topics, but we may just play it by ear. How are you, Zoltan?
Hello, Jama. Good evening, and hello, everyone. I'm doing excellent. Thank you very much. Nice to have you here.
Fantastic. I mean, Zoltan, I thought I'd start with a very simple question, and I don't think that I asked you that before. How did you get into trading?
Actually, it's well, back in I think 2009 or about 2000, around 2009. I was kind of looking around the internet for ways to try to make some small secondary income, and I came across some advertising of some forex site, and I believe that was old eToro, and I had some of this internet money on PayPal and wanted to do something with it. It was too small to cash out, but it was, I think, something like $120 or so I had. And then I deposited like $20 for eToro. You could do at that time $20 minimum deposit. I think it's lasted probably an hour and a half. I pretty much blew that away, but I was kind of like hooked to the idea. And then that was enough to kick to start to look around, and then I find a little bit better broker for second time, and that was FX Open. And then I deposited $100 there, and basically that was my first start. I had with that account, I think that was maybe in a 5 months, 6 months, it went up. I grew it really quickly, like all the beginners doing the risky trading. I think went from 100 to 1,300 and then all the way back to 300. And then I said myself, okay, stop here and then do something a little bit more serious. And then I went with my first normal 4-digit account thereafter.
Yeah. And so when you look back, Zoltan, what do you think? How long did it take in total until you have developed that strategy you're using right now and doing so very successfully?
It's interesting because I was for part of the things that I'm using, one of the thing, and I think it's always a debate which is useful, which is not useful. But for some reason, back even in 2010, I was looking at RSI. Now, not in the way that the book is teaching you, but in a different, my own way, I was using it. And even now, 10 years fast forward, I still do use RSI in my trading. That's what I have it in common. And I would say probably since around 2014, I am pretty much using the core. Didn't change at all what I am doing now. It did evolve some, but generally it's the same pretty much.
Yeah, and just to give people a general idea, so we are talking here about, and correct me if I'm wrong, so lower time frames scalping, sometimes only for a few pips, no?
That's correct. Yes, I am mainly a scalper. Actually, I used to do both swing trading and scalping. The approach generally is very similar between them. Of course, different time. But what I have in back in 2017 when I went full-time trading, to manage some money as well, and kind of with each other, both scalping and trading on the same account. So I came to the choice, and then I choose what I also changed a little bit. Then back in the older times, I used to do scalping from 5 minutes and 15 minutes. Now it's mostly the 1 minute time frame. So it's really the faster the better the outcome. I'm looking for a couple of pips. No, anything between 3 to 10 is fine.
Yeah, and I'm really excited because Zoltan, you also have a lot of experience in the trading and forex industry, and give people also a general idea. First of all, I congratulate you to these consistent results you have been putting up. I think for at least 2 years now. That's really, really good. So your strategy seems to work for you for sure. And second, we all is that's something we can elaborate on later. That you really have a tight grip on risk management. No, I love those posts you made when you were talking about, look, this is what I could lose. This is what happens if I lose that. Consultant, and I would like to know how you think about that. Professional traders, they do exactly that. They have a very, very precise idea about what kinds of risks they're taking, whatever strategy they use, whatever risk tolerance they have. They really know, okay, now I'm taking this kind of risk, and if I do this and this, I'm taking that kind of risk. And I think you do that very, very well. And I also believe that's a big part of your consistency,
Thank you very much. I believe, I've been there at the beginning, like everybody else, trying to do the risky trading and, grow the account fast and make, lots of the people looking at if they not make 50%, 100% a month, that's not enough. Of course, when you trading account and you have basically fully disposable money, say $100, you're gonna blow away half of that or the whole thing. You're not gonna have really problem to it. Most cases, people handle it as a lottery ticket. But I
Yeah.
find myself, once you start to have a bit more serious account in the retail side, I would say if you have about, let's say, a 5-digit account, somewhere 10,000 plus, suddenly that money is already start to mean something. And you cannot blow a $10,000 account and next day you just walk into the bank, take another 10,000 and put it on your forex. That is a little bit too quick. You have to start to handle it with a bit more care. And also, I find myself, especially the last few years, that I am tired of trying to chase the big returns, and then without big risk, there is no big return. But when you have the big risk, it usually comes with big drawdown as well. Eventually, it's always gonna catch up with you. Now, when it does catch up with you, then it's very easy to blow a big chunk of your account. And once it's done, then it usually comes not only with the loss of the money, but it's with an emotional turmoil. So it's you having all these emotional issues, trying to recover, trying to revenge trade, trying to beat yourself down because you made a mistake. It's all the wrong things. But I always say, when you keep a consistent profit, and it doesn't have to be a whole lot. First of all, it do add up over the time. Second of all, it's once you're winning, you don't need to revenge trade because nothing to revenge, right? You don't have those sort of emotional issues. You don't need to beat yourself. Okay, you can be upset for yourself. Okay, I could have this trade and I could make twice as much money on this than I would be making otherwise. But the same time, it is not really that big an issue. There is always another trade around. Also,
Yeah, and correct me if I'm wrong, Zoltan. I'm just trying to give people a bit of a background based on what I read on your threads. So, for example, what you would do, and maybe you can go a bit more into detail. So you pick like 3-4 forex pairs which have a high daily range in absolute pip terms, and then you often do like you look for overbought, oversold levels with different tools, and then you often go for like a basket. Fair description?
Right, yes. My scalping is basically is trying to have when the price is moving to certain extremes. I looking for pairs which tend to be moving a little bit more, simply because when they do reverse a similar percentage in volume, then that similar percentage is representing more pips. Now, if I am looking to get 5 pips, it's a lot easier to get 5 pips out of a pair which moving 100 than a pair which is moving 20. For that reason, I also, even though I living in Asia, I skip Asian session because usually the Asian market is flat. Simply is not efficient for me to try to get 5 pips out of euro dollar, which is sometimes moving only 17. Before the beginning of the year, some of the Asian session I was waking up Frankfurt, it was only showing 9 pips range. I mean, what to do?
Hello, Sultan, did we lose you there? Okay, Zoltan, here we go. So you were just describing your approach, your strategy, and you were talking about the average range of the pairs you like to trade.
Right. I do like to trade those with the higher ranges, especially so I find that is a lot easier to do the fading in it. And one of the advantage in a smaller retail level, and there is only so few, that the ability to go in and out. You have the brokers with the B-book, and they basically to a 1-2 lot, a couple of lot, they are pretty much without much a look. They're gonna take your trade automatically with a tight spread, a lot tighter than the actual market would offer. This is one of the advantage where you don't need to worry, and you can use this situation to your advantage, especially with quick spikes. Uh, if you careful enough and you time well yourself, then you are able to take a few pips here and there out of the market, which you could never do in a larger account.
Absolutely. I mean, I can confirm that. I mean, that's a very advanced topic, but if you trade a very big account, what happens is when you place trades with a lot of lots, you get seen and you move the market. Actually, as you know, I have a little indicator for that as well. But yeah, that's a pretty advanced topic. But maybe, yeah, if you could, Zoltan, maybe you can describe a bit. So you used lower time frames, you used the high range pairs, and then you go for like some kind of reversal trades, and you are
Right.
happy with like just a few tips. Now, obviously, the question now is, okay, what happens if, for example, the price goes up, you add a short trade, another short trade, it goes up a bit more, you add 3 short trades. What happens in those few cases where it doesn't, go your way and you can close everything with a nice profit, but it actually moves in the other direction? How do you
Right.
normally manage this?
Most of the time, most of the time, that the early trades, first of all, I'm not trading all in. It's always a discussion there. Lots of the trading material is advocate of, you have a single entry, you risk 2% of your account, you have a tight stop loss, whatever, and then you find yourself being stopped out, being annoyed, being revenge trading, and you probably not end up actually winning the way that you're supposed to do as described by the book. What I generally do uh, instead, I kind of maybe poker game would be a good comparison. You never play poker going all in with your first 2 cards. You wait until you see a little bit more. I kind of place some of the scout trades, a smaller size. uh, I know how much is my maximum size I looking to put down on a trade. I know where I want to be out if I losing, and then I determine that by equity. I using an equity stop loss. So basically I allow a certain percent of my equity, but I'm not loading up the trade at the beginning. If everything works out fine with the scout position, great. If not, then I am ready to use an average there, but I'm not using also a random point. Generally, you were asking, that apart from the range, I like to have as a catalyst most of the time some of the key levels for the day or for the week. I'm looking for levels like the current day's high and low, yesterday's high and low, the weekly high and low, something, and then see how the price is when the price is approaching and reaching those levels, how they are acting around. If the price is, let's say, very often, again, classic teaching that you place your stops above and below these highs and lows, right? So when the people are actually getting those stops run, that's when I'm looking to get in and fading that move, because I expecting that the market is already overextended at those levels.
By the way, as a little footnote, that's how you used the MK web. No, you saw all the stops get taken out, and you went for post stop run trades. No?
Exactly. So whereas your MK web is actually a very useful tool, because it's also showing to trade toward it, but is a little bit more of a swing trading time. When you have a certain size of move, certain short or long dub money positions, and then you trade opposite way. What I am using usually your MK web, I'm looking, then actually those stop clusters, when they get reached and taken out, very often you find the market, at least on the short term, gonna reverse there. Couple of pips, it's fine.
Yeah.
Sometimes.
Okay. So just interrupt you. Yeah. So to summarize for the listener, so Zoltan said very important things. So first of all, he explained how important position sizing is. So it's not that he places like 2% in one go in one single trade setup. He works his way in. So he may start a little, maybe increases a bit later, depending on how the setup develops. Because exactly like you said, Zoltan, many people, they don't understand that position sizing is a vital component of any trading strategy and trading approach, and it goes far beyond just defining like a percentage risk per trade, right? Especially if you do something so delicate like 1 minute scalping. If you look for bought or sold seven levels using RSI or TMA or Bollinger Bands and other tools, but you want to make sure that you don't enter, and then if there's a move in the other direction, you're standing with the back against the wall. No, so for people, it's very, very important to understand that, and maybe you can comment on that once more, Zoltan, that the risk management, including the position sizing, is obviously completely connected to everything else you do, to your entries, to your exits, to your risk, isn't it?
Exactly. I would say, it's the part of the position sizing, and especially the expectation out of a trade, whereas lots of the trader and lots of the time they expecting kind of like a home run out of a trade. One of my pet peeve is like lots of the people into this risk reward, and it has to be high. They find a high and a low, find a relative tight stop loss, and then they start to measure 2, 3, 4 times because the market have to be there, because that's the good risk reward. I don't really care about risk reward, especially not in the short term trading. What I care also that talking about small scalping entries, they don't need to be a home run at all. But if I have, for example, just use it, if I have 10 trades a day or 20 entries a day, and each of them is only making, let's say, 0.05%, which is tiny bit, then I don't need to risk even 1% of my account to basically have that tiny bit of the things. I can do 3, 4 entries, and I'm still not going to be down minus 1%. If I get that return and I move on to the next trade, if I have 10 or 20 of them, I can make still 0.5% or 1% during a day. There is 20 trading days. That's about, the magic 10%. it comes together also from 20 times 0.5%. And it doesn't have to be that you're making each trade 3 or 4% home runs and then you're being stopped out lots of the times. I also not looking as a single entry, but I looking as a pair setup. And pair setup, I would say if you trade small enough and you're not loading up too early, then pair setup, you have a very, very high probability to come out ahead. Then you move on to the next one, and each doesn't have to represent really a huge amount, but because of the number of the trades, they do add up over time. Then end of the month, you're gonna find still a very healthy profit.
Yeah, and you have shown us exactly that. I mean, if you want to take a bird's perspective, Sultan, I would say, and also based on my experience of system testing, I would say there are different categories of systems. Like there's this one category where it's about risk-reward ratio, but they're typically longer time frames, because on the shorter time frames, as we well know, the algorithms of the banking cartel, they don't allow any good risk reward trades, really. You know, on a minute chart, 5-minute chart, they don't allow for a good risk reward trade. So the strategy you are following is basically the other category, you know, a high win loss ratio, where most trades or most trade baskets are winners overall, and a lower number of trades represents losers. But then also proportionally, the amount of loss from the losers is proportionally larger than what you would make on an average winner, isn't it?
Exactly, you know, I would say so. But also we didn't yet talk about, of course, with the entries, because of the, I was mentioning scout trade and that smaller, you know, later on, if the setup is actually presenting to be the price, but you know, sometimes you balance between a chance to be missing out or a chance of, you know, upfront it's very hard to define, for example, that okay, we reached yesterday high. You know that you can enter at the high and say maybe it's gonna hold, especially for touching at the first time, it's likely to hold. But if it breaks, are they gonna run the stops for the next 10 pips? Are they gonna do the next 25 pips? Very hard to know. And almost certain they're not like run straight up because it's just not how the market is reacting. So you can do some of the, and again, there is a lot of discussion about lot size progression. I would say just a variable lot size. Of course, you don't want to be too heavy early, but once the you know, the probabilities, and statistically you can come to those probabilities are looking better, there is no point not to you know, to put down a little bit more of your resources and try to benefit more. Whereas people are often counting pips. I always say when you come to trading, you're not trading for the pips, because that doesn't gonna buy you anything in a supermarket. You're trading for the dollar. Now, because whenever I go out in my supermarket, they don't take pips. And I don't care if the pips are negative or positive, because if you make negative 5 pips on a one lot and you make a positive 5 pips on a 1.5 lot, then you actually having 0 pips, but you make money. And I really ultimately care to making money, because you know, when you know, there is a lot of the concept, and a lot of the time you find the people trying to chase perfection, which is great in a sense, but end of the day, when you know, you sit down and you start to think, why do you trade? I think the answer should be clearly, you trade to make money. You're not not trading to make percentage. You're not trading to make the high win rate. You're not trading for risk reward. You're trading to make money, and you should never forget that one, that you're trading for money. This is
at a reasonable degree of risk, isn't it? So, like, to make money at a reasonable and optimized degree of risk, no?
Exactly, and this is where it comes into the nicely into the equity stop loss. You know, generally it should be a number that gives you enough room to deal with your different sizing and the different scenarios. So it's sort of in a way, it's sort of opposite to a tight stop loss. you're giving yourself some chance. It's like you having a pistol for a shooting or a shotgun. The shotgun has small bullets, but you have a lot better chance to hit your target with it, you know. Maybe it's not the beautiful one. It can be looking a little bit messy at times, but you have the highest chance to come out ahead hitting your target.
Okay,
And
let's talk about this a bit, Zoltan. So basically, to summarize, most of your months look very good, and then there are very few months where you are down. For example, 6-7%. So that's what we are talking about now with the equity stop. No, and I have to say, congratulations that you have proven this ability to implement it, because I mean, look, your approach is quite discretionary. It would probably be very difficult, almost impossible to automate it. We can discuss about that later. But what people need to understand, so resulting from your trading strategy, you will have a lot of good months with nice returns, and then there will, of course, be some bad months. Now, in those bad months, and correct me if I'm wrong, Zoltan. So, for example, let's say you start the month, you got into a trade a few times already, and then suddenly, like, it's one of those few trades where the price, goes the other way, does a stop run. So then I would say, okay, this trade basket failed, and this is now approaching my maximum equity tolerance. Boom, I close the whole thing.
yes, the thing is that with equity stop, I think it's very important to choose an arbitrary number you are fine with. That it's not only that it's giving you on one hand it has to give you the room and the ability to correct an entry which is running against you some, but in the same time it has to be also a relative tight number. I would say usually about 10% or so of your account maybe you can give up. Why I would say that? Because it's something you can recover in a relative short time. You have the ability, and also very importantly, it doesn't gonna drag you down emotionally too much. You know very well that the more percent of your account you lose, the more percent of gain it takes to get back to break even or to your high water mark. If you lose 10%, it takes about 11% to get back to your high water mark. If you lose 25, it takes 33. If you lose 50, then you need 100% gain to get back to even. Now, with your half of your capital, that 100% gain gonna take a long time usually. It's no point to give up all of that and then being done in the lane that you start to do revenge trade, over trade, too risky size trade, and then you most probably gonna just dig yourself deeper in the hole.
And on average, Sultan, how often does it happen? Does it happen once per year, twice a year? Is there like a rough average where, for example, you get hit?
I would say that probably if you keep it depends how tight you keep and how large the size you trade. I would say that that on average maybe around 2-3 times a year maybe you get hit. Sometimes it's just simply the market. We were talking about like the sizing is a retail advantage. The flow of information and the access to information is the disadvantage of retail. Sometimes you're just the last one to get the information, and that's when you get caught out. The safest thing is whenever something important coming up, it's completely ignore that pair or the action, because you're gonna have a higher chance to get caught out. Lately, for example, to use a current one, the Brexit talks now heating up again. That is gonna be a trade deal or no trade deal between EU and Brexit, EU and UK for the Brexit, and then nowadays it's very common to find some of the spikes out of the blue on British pound crosses, whereas it could be a great opportunity it's always a double-edged one, and you know, if you happen to be in a trade, you can get caught out in the wrong foot. Maybe it's safer to move away from this time totally from the punt pairs, and maybe trade something which is a little bit less hectic. This time I started, for example, the last 2 weeks to trade more of the Australian dollar pairs, Australian dollar, US dollar, Australian dollar, Japanese yen. They kind of offer a more stable environment for the time being. Just have to adjust, you know, for the situation. Sometimes the scenarios change, and also I think it's a good advantage if you're trading. You know, many trader is advocating that you trade, for example, one pair, and then you master that one pair, and you know that character of the one pair. I would say that puts you in a way in a disadvantage. I think if you have about a half a dozen pairs, or maybe I follow myself about 12 crosses, not trading them all, but I following them, and then just whichever is presenting the best opportunity at a given time, I have a chance to pick from that basket of currencies. If I would be
Okay,
only
so let's be very
trading
clear
with
about
one
this.
pair,
So
sure.
yeah, so just to put some structure. So let's be very clear about this also for the viewers. So the approach you're trading, it only really works overall if to come back to the equity stop and the difficult days, if the trader really sticks to that kind of rule, like you said, for example, you know, like a 10% equity stop, and if something really goes out of control, one needs to have the discipline to really, you know, like cut it and say, okay, this is one of those scenarios. Because otherwise what happens, Zoltan, like you said also, the price may go even further, the drawdown is even higher, and you know then the whole strategy is destroyed, isn't it? Just to come back to the risk management part, and then, you know,
Right.
to finish.
Yeah, I would say yes. That definitely that's correct. You know, especially since at later point you load up more of the multiple entries. They represent a larger size. Of course, the drawdown is gonna exponentially explode on you if you keep getting adverse scenario. Uh, I would say it is one of the most difficult part to keep the discipline to take the loss. And I find myself because I also manage money, and there you don't want to make second guessings. You agree with certain conditions with investors, you want to keep to that certain condition. I find myself the very best thing is in a sense to outsource that task. What I do basically, I have a trade copier. The trade copier have an automatic equity stop loss I can set up on it.
Oh, yeah.
And on the manage accounts, it at that point is get automatically close all the trades without question ask, automatically stop copying further trades, and basically that way it is out of my hand. Because sometimes as a trader, you know very well that very often you can feel that, okay, this is the last leg, this is the last shakeout, and you know very well down in your guts that this is the case. But if you have a certain way you agreed with, especially investors or with the funds, and you have to keep to a certain scenario, or nowadays very popular some of this proprietary trading, then you cannot second guess your approach. You know, it can cost you. There, I think for me at least, which is working the very best, let it be by the software. Software automatically take the loss, and then I can deal with that later on.
Yeah, I
I
mean, I
also
think
would I also would add, you
I
know, that
remember
for the
I really
later
liked,
on
there
that
was this one situation, Zoltan. Yeah, where you said, you know, like I don't know, was a few months ago, where you said, oh, the month started badly, so I used the rest of the month to work my way way back. So that shows you also that, of course, it's discretion. No, you also use discretion in your risk management. Also, how aggressive you may approach the market. Let's say after a big stop out or after a great run. I guess. So if you had a great run over a long time, which you had, you're also aware that with each day, in addition, the risk increases that there will be that bad day, isn't it?
That's correct. Yes, of course, it's one of that controversy. The higher your equity get, that same percent gonna hit you even more. Because it's gonna be the higher amount. The worst thing is to get your drawdown from a high water mark. Uh, that's always cost you the most. However, when it's a loss also, if I take a full loss, I try to put some distance between myself and the market, maybe for not only for that day, but maybe for the next day as well. Walk away from trading, and very often I do come back to trading a bit gradually. I not maybe I there is a sizing flexibility, of course, unless somebody really trade a tiny account and then they only can place 0.01 lots. Later on, at a certain size, you have all the flexibility. You can easily place 10, 20, 30% smaller trades. And I usually like to come back small, build back some equity, and then increase back my normal risk size as the equity is being built back. I don't. I try to avoid to be hit too many times with the equity stop, because that would be really, uh, counterproductive. It's a lot better to build back some, and a lot better to come back even a 10%. What we were talking, it's a lot easier to recover back from 10% than recover back from 20%. Uh, and in that case, I just try to avoid losing too much so I cannot come back. Of course, in the same time, once you are ahead in the year and you're having a great winning streak, and I had that one, for example, this year up until July, when I had one of the stops, basically my one losing day this year, and that was the case that I have a great run. I was way ahead of my projected profit, and I take a big bet. Didn't turn out very well. I make a mistake there. I was waiting too long. I realized that it is a weekend coming. The volatility started to dry off, and I was in an unlucky situation because it was a minor cross. It was Euro New Zealand dollar. Um, Simply there I was a bit deeper in volume. You cannot move volume there. You cannot scalp around in a thin market with a minor cross. Even the retail broker gonna see that one. They just don't trade that often, and then you suddenly start to find too much of slippage.
Yeah.
I took the loss. I That was a calculated one, and then I said, okay, uh, I am still doing fine for the year. You know, sometimes you have to take a calculated risk, and then it was my chance. I was
Absolutely.
way ahead. I had the chance to make either a 200% year right in the middle of the year, or I have the chance to go back for 100% year. I was taking that chance. uh, I am about just a little bit under my high water mark back now. I was taking after the bigger loss. I was taking
Yeah, I mean, I think that's absolutely fine if you ask me, Zoltan, because also when you read market wizards,
the
that's what a lot
size
of
down.
the really good traders say as well.
I would say, yeah,
Hello, I think we
it's
lost you there, Zoltan.
no, I am here.
Now we hear you.
Okay, so what I
Yeah, I
was
mean, if
saying,
you ask me,
that
hello?
my expectations are not really large, and then basically I would say 6% a month does 100% year, and I would say if somebody is not happy with 100% year as a retail trader, then I don't know what's make you happy, That's
Exactly.
already
I mean,
huge. So
yeah, I mean, my opinion
I
is,
was
regarding that kind of strategy. I mean, yeah, but that's fine. Like sometimes if you have a good run and you're doing fine, and then you want, like to take some risk to maybe do like the extra jump. I mean, that's absolutely fine if you ask me. And
uh,
the strategy as such, like
and
if it's such an active strategy, I mean, it will have those parts. No, like there will be some of those bad days, but as long as you protect the overall percentage, as you explained,
exactly.
it's
I would say, if you generally have a projection where you're supposed to stand, and if you are way ahead, you can use some of that extra money to risk a little bit more. Uh, Basically, if it pays out, fine. If not, then you still not worse off really than you supposed to be projectedly there. You know, take my year. At that point, I was way ahead because I had a fantastic March when it was very, very volatile. I I had a very high two-digit gain for March, and I was using that profit mostly to take this extra risk, and also it's very tricky because very often you just look at retail accounts, in percent gains, but when you trading retail for full time, one of the things what is overlooked, that it doesn't show up the result exactly like on a spreadsheet. Very often people want to think of compounding and in a spreadsheet fashion, but when you really trade full-time retail, they have to understand that you keep withdrawing from your account as well. So you might show a larger percent drop, but your beginning of year equity and the middle of year equity is maybe not exactly the same level. Sometimes the equity level does fluctuate, and also you need to withdraw money for good month and bad month as well, because that's very how you pay for your bills, so it doesn't really compound the way, but in the same time you can use some of that compounding. It's just not the whole thing.
Of course, some people, Zoltan, they will now say, well, but this strategy, what if the strategy stops working? I remember you had some discussion with someone, and, the other person was saying, yeah, but, that was to date, but now if the market's conditions change, the strategy values may change as well. What's your take on this? I mean, obviously, look, if you have a strategy, you can't expect it to work for, 20 years, isn't it?
Right. I would say probably that's true. In the same time, my finding, after even 10 years, I'm for example still using RSI generally, in my way at least. And then what I would say, looking back at charts, even on what I was posted before 4 years ago, 6 years ago, uh, and I'm looking back those old charts, and the market change and not change in the same time. As I said, the pairs change the characteristic, but if you're not relying
Hello?
only on one pair, the overall market condition that they have every time they have a yesterday high and a yesterday low, every time they have the people for whatever reason looking to buy up a currency or sell out a currency, uh, there is gonna be always some sort of little imbalances on the market for whatever reason, be it a news or not. I would say, let to give an example, coming into 2020, euro US dollar had pretty much the lowest volatility for the past decade. The range of the euro US dollar was extremely low. Some of the days were finishing with 40 pips coming to this January. Right now, that's not the situation. After the pandemic and all, right now it's a very tradable pair. But in January, you could not take a trade really to fade on euro US dollar. There was days which were really just flat. On the other hand, they can pick up at times, but it doesn't mean that in January, because fading euro US dollar was not working in January, it didn't mean that you could not fade British pound, Japanese yen. They were still presenting the same characteristic and the same scenario. It just if one pair doesn't have the volatility, let's look for another one. But to give other example, what is changed, for example, for this year, what I noticed that in 2020, these so-called high-impact news, they stopped to work. Now you have non-farm payrolls releasing, and they have huge changes in them, but the market just doesn't react for them. The market loves to react this year for Twitter messages, doesn't like to react for high-impact news. Something which maybe for 2-3 years ago was my bread and butter days to make my, sometimes you could make like a week worth of money out of a non-farm payroll. Nowadays, it's pretty much a no event. There's nothing to feed there.
Yeah, I mean, I call this fake momentum, Zoltan, because sometimes you have like news results, but the dumb money is placed correctly, so the smart money doesn't want to make the move and make the money, so they just don't do anything. It's so they disregard any economic plausibility. But that's a very complex discussion regarding. I tell you something, Zoltan. I have one strategy, one of my favorites. It's an automated one. It's a bot I created, and over a tick data test with everything, slippage, variable spread, commissions, and all that. Over like a 6-year period, it does very stable returns. Very relationship between drawdown and risk and return. But you think, okay. Over the last 6 years, there were so many changes already in the market. The market was ranging, it was trending, it changed in terms of the range, it changed in terms of what you described, the reaction to news and all that. So I came to the conclusion, well, I have a good chance that this works for a few years, but obviously, let's say in half a decade time, things fundamentally can change, like, which will also impact the markets like they were never impacted before. So, of course, after 5 years, with every additional year, the risk increases that it will not have this stable curve anymore. But, it's a very, very complex topic. What I feel, Zoltan, when I look at backtesting with real data, I see that there are certain characteristics per year. Like you said, for example, in 2020, in euro dollar, let's say the range was tight and then the response to news was very low. I can see similar characteristics in other pairs. For example, if you go to 2017 and then you compare to 2018, a strategy which is based on, let's say, reversals, didn't do as well, especially mid to, but it may have done very well over the whole of 2017. So what I'm saying to conclude this is, yes, there are certain, so markets change on a regular basis, right? Otherwise it would be easy. And of course, the smart money knows that, people are using strategies and programming boards and, trading on a discretionary basis, and they have certain approaches. So they know that on a regular basis they need to change those characteristics of the market. And we all know changes between, trending modes and ranging modes. Like look at euro dollar in the last weeks, with the crazy moves, the trend moves almost without a pullback, going in one direction. So of course that would have, hit like any, let's say, reversal strategy.
Mm-hmm.
So I think the good aspect in that context regarding your approach is that there's also discretion, like you described, regarding the selection of pairs, right? One pair may change, but maybe you change with it and you go to another pair, isn't it? So that's also, so that's why I would call your approach very discretionary, Zoltan. Would you agree? Because regarding entries, risk management, selection of pairs, aggressiveness during the month, and so on, you obviously use common sense, your experience, and discretion, isn't it? Did you ever try to automate this?
I was looking into automation with some a great coder, but the thing is, I find exactly for what you're saying, and generally because the pair is changing. When you try to automate something, that discretion part you cannot really code into perfectly. It's very hard to, but you can yourself interpret the data differently than a set of code can interpret. And
Yeah, absolutely.
and
I mean,
and
if you try to work out the strategy just by saying, okay, use those indicators to define potential entries and so on and so on, even if you make it very advanced, Sultan, then the strategy still doesn't incorporate those other decisions you made, like you described, to say, okay, this is a good period now, maybe to switch to Australian pairs. Before I was doing some pound pairs. Like these decisions, which seem to be quite simple for us humans, they're very complex for a machine to understand and to do in any kind of autonomous fashion, isn't it? Even if you use intelligence or self-optimizing, it's I can tell you from experience because I've spent a lot of time on automation as well. It's very, very, very complex. These are the situations, Sultan, where there's actually the advantage for the human compared to the machine, while there are many other situations where the machine has an advantage, isn't it?
yeah, I would say definitely, and then also, uh, as a human, you able to apply the discretion really a different way, like for example, this current week, British pound pairs had a lot of the spikes randomly reacting for the news up and down. In a way, they were presenting me those extreme scenarios what I normally like to fade at my own discretion, because you don't know actually what is moving behind, and acknowledging that my information as a retail trader gonna be always inferior, and I have no idea what is really behind until I read it minutes or an hour later, uh, and I cannot uh, really estimate the magnitude of that news. And but knowing that somebody else with better sources, they have it, and I cannot really think that this is just a one-time 50 pips spike, or is gonna be a 50 pips spike what is gonna spike another 200. It can.
Yeah,
We had seen that
yeah.
one so many times. For me, I was choosing to stand aside most of the time, and what a robot usually you cannot really calculate very well. That the robot say that, okay, given this certain scenario, my position on the market is to be on the sideline. Trader, as a discretionary trader, being on a sideline is also a position on the market. You position yourself to be on the sideline. It might not make the money for you, but sometimes it's more important not to get yourself in a scenario that you actually don't know how to deal with. Referring back what I was telling earlier, if I know this was the weekly high and I'm looking to fade the price there or short the price there, then I can estimate that the price was moving previously there. It was a long time or recently there. Uh, how much chance is there that the stop losses are placed there? What is the estimated distance where the stop losses might be from the given the volatility of the pair, the willingness of the traders, how given the pair, maybe it's a widely traded a major pair or is a minor pair, which in a minor pair you can probably a lot thinner traded is a lot easier to move the market and fake out, to actually hurt more people if you wish, by running the stops. And then you can place yourself according to that one. I might expect the price to move in 10 or 20 pips, but very often you see that it might run 50 or 60. Now, if I really use up all my trading lots early, then I might be in a drawdown and maybe even risking stopping out. If I trading a little bit lighter, I might miss out to making the maximum gain, but I definitely not gonna have much a chance to stop out because my drawdown will be still relative minimal. Just because my equity is down 1% or 2, that's really not that alarming. Uh, Without risk, there is no money to make. We have to accept that one. that's a calculated risk. A 1% drawdown is really not too big a deal.
Yeah, I fully agree. I mean, I think when it comes to manual trading, even if it's 1 minute scalping for a few pips, it's essential that one is able to wait and even whole sessions. I mean, and I can tell you, Zoltan, no matter, you can talk to any trader on the world, any short-term approach, it will be an essential part of it, because the truth is, and that's what many retail traders do wrong, because everybody sits in front of their screens and they want to click the button. That's what people want to do. And they want to do that
Yes,
every
that's
day as
correct.
well. And the truth is, so to look, and I can tell you, even with the access, for example, of all the data, even if you see the MK web and so on, you see the stops, the positions and so on, I always remind people, look, you still need to have the discipline to only click the button if the probability is in your favor. And if it's not in your favor, don't gamble. If it's a 50-50 chance, either trade very small and use your position sizing, or skip the trade if you want to be puristic. And that's an essential part of manual trading. And it's not that I like it, because everybody likes to push the button and have action every day and do routine trades. But the truth is, Zoltan, and I feel very strong about that because I've really looked into this. The truth is, any kind of manual short-term trading requires you to be able to say, okay, now I will not do anything. This day I just skip. This looks too crazy. I will not risk my capital on this. I will not just place a trade just to place a trade. And the reality is, Sultan, it's easy to say that, but when it comes to humans engaging in the market, the reality is, Sultan, that most people, they fail at those kind of things. They have pressure. For example, that's another topic. Which we probably should not go too far into that. But if you trade for other people, for example, and they observe what you're doing, there can be a certain pressure that you need to put trades. But as a trader, you need to be very, very puristic. If there is no setup and if you don't see any edge, just my advice is don't trade, skip it. And nobody likes waiting. Everybody wants to be in the action. But the reality is, even scalping, Zoltan, it is like sniping. You need to wait and you need to have the patience. And then once the opportunities come and everything aligns, then you can click the button. But don't click the button if you are not sure, is it?
I totally agree with this one. Yes, I teach on one by one basis. Some of the guys look out to me, and then one of the thing but earlier I said, first it's important, keep always in your mind in the front that you're trading to make money. You're not trading for the excitement. You're not trading to make pips. You're trading to make money. If the money is not there, then you shouldn't. How to decide if the money is there? My suggestion, first of all, do your testing, do some statistics on each pair, find out what is your sweet spot there when you have a high probability that this trade should work in your favor. Even if you find your high probability, it's still a lot better to divide up your positions and not to be all in, because even when people talking about support and resistance or whatever you like to call it, even a daily high, that's not a single 0.1 pip line on the chart. That's about like a zone. You try to cover it just like that shotgun. You have a certain zone, you zoom on that one, you say, okay, this is the zone I like to place my entries. This is what I expecting out from that zone. And very importantly, one of the things that I also tell the guys I'm teaching, once you have your statistic done and you have your tradings done, try to come up with some way, like grade your entries, grade your setup. Is it an A grade setup? This is a B grade setup. This is a C grade. I always say below B grade I don't like to take any trades, because to be honest, it would be a waste of energy. You can if you trade, and if you really want to trade those C grades or even B minus and Bs, that use your discretion, use your tools available there, size your trade accordingly, size it smaller. If you have a grade C trade and you use a 30% of your normal size, that even if it goes against you, you can correct the trade by the time it's becoming a B or an E. If you have an A grade trade, you can put down more of your money as well. You don't need to trade your normal size. If you really find a scenario yourself, for whatever reason, maybe you came back from the lunch break and you find there is a fantastic entry there, which is telling you that there is a very high probability for a certain scenario to play out. Nothing wrong to put down 120% of your normal size. You have to be flexible with it. But if there is no trade, there is no high probability setup, stay on the sideline. I always say, my favorite pastime as a trader is, or probably the most common, watching YouTube videos. Not trading, non-trading YouTube videos, like Penn and
Yeah.
Teller's Magic, or whatever, doesn't matter. But if you flipping long enough on the charts and you keep putting new lines on the chart, one more trend line here, one more time frame there, then you draw a Fibonacci, then you draw, whatever this channel that. Any sooner or later you're gonna find a line which gonna interact with the pair just to justify a trade, but that doesn't gonna make it like a good trade. The very best thing, if you learn to be patient, wait for your trade, wait for your high probability setup what you find in your back testing, and if you find that scenario, then trade it accordingly. If you don't find that scenario, stay out of the market. It's no point to, I always say, think like you are like a battery. You have 100% energy. Even if you waste your energy done for so scenarios, then once you need to focus, you don't have any more energy to left to focus on the right time, and that can cost you.
Absolutely. Allow me to interrupt you there, Zoltan. So that's a very, very important point. So first of all, to go back what you said at the beginning, the testing. I always say, even if you're a manual trader, still do some tick data back testing. Because you will be shocked, Zoltan, how many strategies that look visually good will completely fail over a relatively short time period. I mean, that's actually shocking, and that's something I should maybe also do a separate video about and demonstrate it as well. People, for example, they put some indicators together and they go back a few days and say, look, this looks pretty good. It may not have 100%, but just like 70% rate, that's good enough. Now, I suggest what you do is you take real tick data, you put the strategy together, you let the thing run, you will be shocked how bad it will be performing overall. And that, even there will be at best like a small period, a short period of time where it did okay, and then it completely dies off. And that will teach you a lot of understanding as a manual trader, because you will realize that every time you push that button, you're putting risk, you're putting capital on the line, you're taking on a risk, and often you're as good as you think they are. So it's very, very important, like not only for beginners, but also for intermediate traders. Always, take a look at what the reality is. Because look, my personal idea is, Zoltan, and that's also how I approached the whole market causality, market structure thing, because that was the only way. I took a very radical stance. I said, look, accept the reality as it is, no matter how complex it may be. And then, once you did that, work your way up from there. And, this is a very important process when it comes to trading from my perspective. Just accept as the reality is. Don't come with ideas and try to force those ideas on the market. Accept the market with all its chaotic behavior over several years as a base case. And then, take this as a given. And then everything you do, base it on that reality. Don't come with theoretical ideas. This should work, and with fake causalities, because this will quickly lead to failure without a question. No, and even what you said before, Zoltan, like people who try to apply simple strategies, let's say the high is broken and now there's a pullback, so I enter at the first retest. It may maybe work a few times, but you will be shocked how badly that performs over a certain time period. Like simple trade ideas, which look solid for a while, may completely die off. So my warning is to everyone also watching this: Take the approach Sultan suggested with the spreadsheet. Test it. Put down the numbers black on white. Don't try to, convince yourself that it's better than it actually is. Because the truth is, Sultan, and that's for me a big realization, and that was enabling me also to create really good strategies. But I first had to realize how bad most of the strategies are. And even if you create a really smart approach with a certain degree of complexity, even if this strategy has a certain degree of adaptiveness, still, I tell you that, it will be fragile over a certain period of time. So in order to find something, you really need to put in the work. It's not that easy. And maybe that's another topic you can elaborate on, Sultan, and then maybe we finalize that particular section. The question, so what, simplicity versus complexity in the strategy. So that's one topic maybe, no, because as far as I can see, like when you look for your entries in your personal strategy, it's not super complex, no? You look for a certain combination of factors, let's say RSI or TMA, in combination with some price actions, with some other discretionary factors and also logic, right?
I would say yes. I think it has to be balanced. I think it's with friend of mine we used to say trading is simple but not easy. And I agree with that one. It is. I think if a lot of the time people fail because overcomplicate the things. That basically you have something statistically to use. It's important if you use some indicator to your entry, especially. It's very important first of all to use something which is not repainting over time. You cannot look at 100 period moving average and then you think that is in recent time it was actually doing a crossover, moving average crossover, one of the favorite beginner approach. Usually they fail, of course, they badly repaint, or you have other indicators which is repainting, look nice in hindsight, but it doesn't really work that way in the right time. I see very often people trying too much this very tight stop loss, and they're using a 2 pip stop loss, for example, or such. Even without much slippage, that is too tight in the reality. It's very hard to be timing that way. And if you have real money in the line compared to demo, you're gonna very soon get very annoyed. You have to also
Hello, we lost you, Zoltan. You hear us?
you reversa. So if the market doesn't move in Asian session or it doesn't move in the late US session, then it's not my ideal time. And I cannot force the market to move after I come home from work. And then I am at home 7 p.m. and until 9 p.m. I have the time. I sit down and, okay, let's find a trade. This is not the casino. You can go in 7 p.m. and come out 9 p.m. The market gonna do what the market like to do. They're not gonna be there to please you. Once again, you're gonna come to drawing your lines and then keep drawing the lines until you're gonna find something to interact. If it would be not a monitor, you could draw dots with it. But the thing is that you cannot force your expectations on the market. It's gonna move however it wants to. But more correctly, I have a few simple things, a few simple rules generally, and I would rather call it more a trading approach than a trading system, because it's not a black box type. But for as much I can tell, I like to see after the market at least moved a certain percentage of the typical daily range. With that one, I already be able to filter out basically a flat market condition. I'm not trying to get my 10 pips on a pair which moved only 15 in a whole day. It just would be dumb to try. Very difficult to try to get the very best entry and the very best exit. Maybe you can get it on a back test, maybe you can get in a demo test, but in reality, you're not gonna be always spot on, but you still like to look for profit. So I want a certain move. Then I want an indicator which is giving me the market condition, which is right for my approach. In this case, let's say I'm looking for some sort of overbought, oversold, basically a condition or a scenario with a certain price level, which is giving me a probability I can derive from the backtest. And then uh, along that one, you can use other filters, but the more filter you try to add to be pinpointing better your trade, I think the more you're gonna get confusion out of your trading. You know, I looked
Also
before like
filtering, isn't it? If you add filters, you may filter out the really good setups as well.
exactly, you know, it's, I mean, some filtering of course needed, but in the same time, if you add too many indicators, chances are they're gonna contradict. If you add the similar kind of indicators, that they're gonna just tell you the same thing, you know. If you try to use, for example, RSI and stochastic, and very often maybe they give signal in the same time, not much of a use, right? Also, you have to be careful not to go with the scenarios which is way too often happening, you know. uh, Again, back to the grade of the trade. If you trade the best A grade scenarios, you probably better off than you trying to take every trade which might offer 2 pips for you, and then if it goes against you, then you probably burn yourself badly. It's better to wait for the right thing. I think one of the best indicator is there that you are able to be patient and wait for your things, you know, to come up. You know, you cannot rush the things. For me, one of the big step I think was to learn that it is okay to have a whole trading day done without a single entry. I can let it go, and I don't feel upset of myself if I have a day which I take zero trade. If your conditions are not optimal to you, don't afraid to say that, okay, I'm doing something bad, I have zero trade, something is wrong. No, I, like this past week, I have a relative low return for the week, but I was making some money all the 5 days. So how to be upset with it? If the scenarios are not the right thing, and the position size doesn't land for it to be sizing up for the right return, then I would probably do the prudent thing, trade it with half a risk or 70% of the risk of my normal size. And if it doesn't come to the setup, then I just don't take a trade.
I mean,
That's I
I
think.
had the same experience, Sultan. So I had a really nice run, which I actually documented on the channel in euro dollar. I was able to predict like a few moves. But then, the same in the last week or so, there was not, much money. There were not many stops. It was very, unbiased. So I also wasn't able to place many trades in the market. Let's be honest, Sultan, on the manual trading, when there's these kind of days where you did not do anything in terms of trades, it feels weird because it feels a bit like wasted time. But the reality is it's not wasted time. You actually made a conscious decision not to risk anything, not to get caught in anything you don't want to be caught in. So having no position is also a position. And look, this is also confirmed by any kind of testing. When you have a system and it performs well, when you want to push the system a bit more, to do a bit more trades per week, you will see it's so sensitive that suddenly the whole system can even completely die off if you push it so far. And that also shows us, Sultan, how efficient the markets are in that sense. Like the foreign exchange markets of today, Sultan, which are completely controlled by the algorithms of the big guys. Basically, they are so efficient in killing their money and to move in a way which makes most people lose, that in order to win, you need to be able to do those exceptional things, to sometimes, sit on your hands, to not do
Exactly.
anything, to be super disciplined. And that's basically also one of the big takeaways, from this kind of podcast. We're looking at what you are doing, looking at your approach and all the discipline it requires, even when it comes to risk management. And the other thing we didn't discuss so far, this balance, Sultan, between being aggressive but also being conservative. I feel, Zoltan, how do you feel? I feel most people, they're either too conservative or they're too aggressive. And the truth is that trading requires you to find some balance. You need to be able to pull the trigger when there's something to get. So you need to be able to take a shot. But it's necessary that you're also conservative enough to say, you know what, I stay away from those kind of setups. I wait for something better, to have this kind of patience. And the reality is, Zoltan, that most people, they are too biased in one of those directions. And that's also a reason, next to all the market manipulation and all that stuff, but that's also a reason why over 90% of human traders fail, isn't it?
Uh, yes, I would say so. It's a very fine line between being too aggressive or being too conservative. It's hard. I think one of the very important thing to come to terms with the expectations, and I always urge people to come up with something what their expectation is, but try to come up with a realistic number. A lot of the trader read forums or see lifestyle YouTube videos, which is fashionable with rented cars and Airbnb homes, and and they set the expectations really very high, and many times I see that people expecting 100% a month just because they have $100, and then basically making 6% a month or 10% a month would be too small for justifying the time. But it's not the market's fault if you have low equity. At the same time, I always say try to put things for the expectations in context. Think of it that your bank is paying you 1%, 2%, or even negative interest in some cases. Really you think that 10% should be as a minimum monthly return, or 10% should be a really very strong good return, because I would always say that if you have an average monthly return, whatever percent, you can always expect at least three times more drawdown at some point on your account. If your average monthly return is 20%, then you can definitely expect a 60 to 100% loss some point on your account. And I would say within 6 months, probably. In the same time,
I mean, that's what people underestimate. Yeah. Just to add a comment, sorry, we have a bit of a time lag, but I'm getting so excited because these are so important topics, Zoltan. So yeah, I mean, I would like to make two comments about this. First of all, look, be realistic, right? I mean, don't think in terms of $100 account. Look, the stock market makes an average 5 to 7% a year over a long time period, subject to at least 3 times that much in terms of drawdown. If you look at Warren Buffett's performance overall, people, and you sent me actually that statistic, didn't you, Zoltan? The actual drawdowns.
Yes, I did. His average yearly gain is 21%. His worst drawdown multiple times about 50. That means you had to sit out. He's considered the greatest investor of our time, probably, and then he been done multiple times. Up to 50%. That is a crazy number. Most of the people think Warren Buffett basically gets his 20% with no drawdown, which is not the case at all. Of course, he's sitting it out. Of course, he's sitting it out in a position that it's other people money. And one of the things what is also difficult to understand, that these so often brought up fund managers, they having their income even if you're losing money, because they have a management fee. In retail, people looking to get a millionaire, but they basically have as much of money as a hot dog cart would be running on a corner of New York, and it's not the case. If you want to make a good income from, let's say, you can buy a McDonald's franchise, gonna cost you $2 million. You want to get a good return from a real estate renting, then you need to have hundreds of thousands spent on real estate. Trading can make you a very good return, but of course, without capital is not gonna be the case. And if you're trading oversized risk, it's gonna come with oversized losses as well. you have to learn to expect about, I talk to other traders also, and very often if they have a salary job and let's say they make $3,000 a month at your salary job, then they looking at trading and they want to have 10,000. I would say if you do something that you love, think of this in terms of just a regular job, especially in retail. You don't have other incomes. Why it should make you 3 times more than your regular job is making, which you probably don't like anyway. If it can make a comparable money, that is fine.
I mean, to summarize, so, it's all like take the account size into account, right? Be realistic. And looking at the things we do, Zoltan, yeah, like short-term Forex trading as compared to, let's say, those long-term investors like Warren Buffett, like the value investors. I mean, of course, higher returns are possible in the world, but of course that comes at the expense of the additional risk, like black swan risk, for example, right? We should also openly say that. So let's say, for example, Sultan, you open your 3-4 trades in one direction, and then there's a black swan event, which is, let's say, an unannounced comment. It does like a 200, 300 pip move in a second. You know what I mean? Of course, if you have, for example, your account equity automated stop in place, you may get filled. But even then, there may be slippage. No, so I would say it's fair to say that when you move in our short-term arena, yes, it's possible to achieve higher returns, but those higher returns also come at these kind of risk factors. Whereas, for example, Warren Buffett, of course, he also can suffer from black swan events. However, most of the time, in the worst case, he has to hold over his stock portfolio over a few years and just wait over like those kind of drawdowns where, for example, stocks are going down. He may earn a bit on dividends and so on. You know what I mean? So I think it would be also very good from our perspective to clearly explain that. Now, obviously, we do, Zoltan, whether we like to hear it or not, when it comes to investing people's money. This is basically for people, who are already invested in the stock market. They already have index funds. They already have, excuse me, a diversified portfolio. So now they already have other things, startups, real estate, metals. And now they look for another satellite in their portfolio to see, okay, what else can I have where I maybe have uncorrelated returns? When everything else is going down, let's say stocks go down, metals go down, and I have maybe an active vehicle like a little fund or managed account, and this is a Forex strategy which may actually go up where everything else goes down. This is basically, and that is what many people don't understand. This is basically where those kind of active short-term Forex strategies become very interesting for the really big. They look at and hedge funds as well, which are more active, and they go long and short and so on. All these vehicles, and let's call them more active trading, they become interesting for them in that space. Because they already have like the normal stocks, they already have bonds, they get already normal returns. So they say, you know what, I may be willing to take those additional risk factors in return for a potential upside, which I don't get on the other portfolio, isn't it?
That's correct, yes. But that's where still we find that most of the people come to retail trading, of course, in a way of it's a low barrier of entry, and it's sort of a gambling, and it's nothing wrong with the gambling part also, because in a sense, when you place a bet and you don't know the outcome, it's in a sense gambling. But if you're not managing your risk, and you're not managing your expectations and your emotions, that you can easily burn yourself. And if you keep burning up relative small accounts over the time, it can also cost you some serious amount of money. Just the same like you would go to the casino with a $200 a time. You end of the day you have probably nothing left, and then you go every week with $200. Over a year is gonna be a lot of money, right? But in the same time, I would say if your expectations are realistic, and then you have a certain number of equity, and then you can set, I would say, probably a single-digit number for the profit, which still can have a very healthy year It can be a triple digit year out of a single digit return per month. I can tell that, basically 6% a month, 12 times compounded, that's 100. So it doesn't have to be huge number. Then once you sort that out and you're able to do that with a relative low exposure, and that's the only chance against the black swan, that you have a low exposure on the market. With the trading frequency gonna make up for the overall profit. But any one time, and that's one of the advantage of the short-term trading, any one time your market exposure, it's probably maybe 1% of your equity or not much more. So even if it's let's say you have maybe $10,000 and then you place maybe a half a lot volume, even if suddenly the market jumps 100 pip, that is worth another extra $500 against you. Jump another 200 pips worth another $1,000. You're gonna be hurting yourself a little bit, but it's not gonna be a catastrophic one because your exposure is small. On the other hand, with the $5 per pips, you're making your 5 or 10 pips, and you actually getting a relative decent return on a short time exposure what you have. You repeat that 5 or 10 times during the day, and you find out that you basically making an equivalent for a salary, not getting a millionaire, but nobody really gonna get a millionaire on $10,000. That's the truth of it. You might find out of 10 million people, one may be hitting it a home run and they grow their account exponentially. They gonna show them, and probably they gonna disappear after, just like, they have top traders. Very often I read about, and sometimes it's a little annoying. For example, Paul Tudor Jones, right? He was in the market wizard. His very best period of trading was his very first 5 years, what get him to the book. He never ever, in the last consequent 35 years, were able to come even remotely close to that performance. Which is okay, but right now he's underperforming the market continuously, even though he has still a huge number of assets. He still trade a couple of billions under management. He's still not gonna starve because from out of the management fee, he's living as a millionaire. Plus he has the money from the high times. But the truth is that he's not making 10% a year nowadays on average.
Yeah, I mean, this is a complex discussion because it depends, for example, also how much money in absolute terms, such a fund manages. That's one. And the other one is, as I said before, if, for example, the clients, investors are pension funds and all they want to do is like to have like an uncorrelated return within a portfolio, even though he may underperform, he may still be a good choice for them in certain situations. That's why I'm trying to also keep the discussions a bit open or some things. And like the other topic we discussed before, when you mentioned, having a small account with high risk, but for example, splitting up your overall capital into small accounts, and then assigning a certain strategy to this account, to that account. Some people like to do things that way. Look, here's my personal opinion, Zoltan. There are many ways of doing things, right? I try to not judge too much on what's better, what's not better, because like sometimes investors are not looking for the maximum returns. They look maybe for something which has very, very tight risk limitations. And by the way, just to conclude that part, that's also my personal experience. I mean, when you work with investors, they can be so different. One may want you to go for maximum risk. Another one, wants you to not, go too crazy. This can be so different, and it's actually a challenge to align what, like people will look for you're working with, because it can be really, really different. For example, one case where the condition is to not use stops. And obviously, if you don't use stops, you may put the account at risk, So these things have to be. My advice is, no matter what you do in the trading arena, no matter whether you're a stock trader or forex or long term or short term or managed account or your own capital, My advice is make sure that you figure out and you understand what the people you work with, what they want, what they're looking for. Because, there are also those people, if you only trade small, even if it's stable, that's not what they're looking for. They will not be happy. But I have to give credit to you, Sultan, because you're one of the very, very few traders who has really, especially in the Forex arena, who has walked the walk in terms of, starting small, then you were able to live from your trading, which is also something special, like that's what most people, can't achieve, to not have big capital, but to still be able to live from your own trading by being super, super disciplined. That's something you have really achieved. And that's really where you really deserve some kudos there, because, you did a great job, I think. And now maybe your next step is also, to expand a bit, to maybe take on some capital. But whenever it comes to those topics, the question is, okay, what is this project about? What is the idea? What kind of risk is acceptable? Because look, some people may say, Zoltan, no, I'm not willing to take the 10% equity risk, or I'm not willing to invest in a project where, I don't know whether in 2 years that strategy may still work. You know what I mean? The truth is, and we got a bit off topic, but there's so many, at the end of I realized, Zoltan, we should probably also make another podcast, because we have so many topics to talk about.
That's
So
correct.
I think,
Yeah, there is a lot.
let's
Otherwise it would be too long. That's for sure. Yeah.
a few topics, and then we make another one, because to discuss. I even have topics here on my sheet which we shouldn't touch upon, because it gets us too far away. But to come back to that discussion, I agree what you said. I mean, it's true that especially in the hedge fund arena, there are many funds which actually do not outperform even the indices. That's well known, right? I mean, there are many, but then the fact is also that the average hedge funds doesn't survive like 5 years. Most funds close down within a period of 5 years, and then of the funds who survive, a high percentage doesn't even over a few years beat the index investing. But then when it comes to active areas like our Forex, yes, there are, possibilities to actually, do really well. But, that comes at the expense of like implied risk factors. And also there's not always unlimited scalability, like you will quickly, look, if you have an account, if there's 60 million on there, you already come to the point where your trades get seen by the smart money algorithms. You get even position hunted, you get stop hunted. These things actually, they happen much lower than many people think. People think it's completely scalable, to billions of dollars. That's not the case. That's the reason why there are not many big exclusive FX funds. You can't, like you said at the very beginning, you can't just scale it up in unlimited terms. You can, but it doesn't matter, because you can do well, with a few million, a few 10 millions, a few 100 million. Also, there's enough to do up to this point where you feel, okay, it's not scalable anymore. And I mean, this is a whole discussion on its own.
No, that's definitely yes.
Yeah.
That is, but it leads back again to the beginning. What I said, one of the few advantages on retail, you're able to size yourself, you're able to find the avenue which is taking up your trade. I would say maybe up to about 10 lot, maybe on the majors until 20 lot, you're not gonna really have problems. Above 20 lot on minor crosses, you start to see at the retail brokers, they less willing to take the other side sometimes. They're gonna start to slip you a lot more than what you see on the quote, because they are not willing that much to take the other side for you. Also, don't forget that they have all the software advantage. They know what you're doing, they know what the others doing, and if you happen to make money, they're not making the income from your commission. Really, they're making the income from the assumption that you're going to lose. It is not a fully level field. When you a relative small player, you can actually navigate between these little nuances. Once you really start to trade a little bit larger, at some point you're gonna alert the broker to it, that you are there, and they might try a few tricks to pull on you. I've been seeing that myself before in the past as well. Sometimes it helps if you remind the support there that you actually are aware of some of these, then things can improve back. But eventually they not gonna be there too long if you start to grow the size. Certain things you can
Yeah, I mean,
evolve,
yeah, I
certain
mean,
things you can
just to
evolve,
comment on
but
that, yes,
not
I
everything.
fully agree with that, and that's true. I mean, you can have like a real DMA ECN broker, which will get you a bit further. But I mean, absolutely. I mean, even if you can get around the dealing desk broker, there will be that point where you get seen in the market, and it's definitely around a few hundred lots, that kind of value. That's what I can say. So, like that happens. And that's the whole other issue. But look, there are other ways to get around it. You can have several accounts. You can sometimes trade on this account, then trade on the other account. So there are ways to get around it. But maybe that's too advanced, Zoltan. I just had one comment here on my notepad. Maybe we can touch a bit upon that, the topic of stops. Look, here's what I would say to start that discussion. If your stops are way too tight, you will just get stopped out, like you said before. That's true. You can test it. You will see it. If it's very tight stops, you will get stopped out either by the broker, and if not by the broker, by the general market moves as they're produced by the smart money algo and the cartel. Now, if you use a wide stop, then it may not get hit that often, but if it gets hit, the resulting loss is proportionally too large to what you made on the winners. So that's a dilemma as such. So especially also when it comes to automation and so on, that's the dilemmas you have to deal with. So of course it's possible to use stops in a healthy range, let's say, but it needs to be adaptive and it needs to be married to the rest of the system or approach. So it's not independent components. People think, oh, I put entry rules and I put exit rules, I put stop rules, and no, it's all connected. If you change one little switch of the machine, everything else changes. That's why it's so difficult, because it applies to robots as well as manual trading. You have this machine there with many switches. If you change this one switch, it may impact everything else, so there's a causality between everything else. And that's maybe something we should just talk a bit about, Zoltan, because obviously you have your own approach. You have the, let's say,
Right.
basket-based approach. You have an equity stops, right? You don't use tight stops, but it's not that you use wide stops neither. But you are very, very strict on your defined rules, even if they're arbitrary. That's something interesting, which I fully agree on. But there needs to be a definition of those rules. Otherwise, you will just disregard those rules and parameters, and that's asking for trouble, isn't it? So maybe can you give an advice, Sultan, to other traders on the buy side when it comes to those kind of considerations of risk management? How can they come up with a reasonable approach which also takes into account their emotional biases in a way?
Yeah, I myself lately especially very big on the toll of the stop loss, what it makes you probably emotionally. You're getting hit too often with it, you likely to result to doing some of the the trading behavior like revenge trading, or being hard on yourself, or system hopping very often comes to people. They losing faith on their approach, then suddenly after one two losing trades they decide that the trading is not right, instead of recognizing that maybe just the market condition changed a little bit, and maybe they just should stay on the side, or maybe they not realizing that they were taking a mediocre setup. Uh, thing again is to do your best back testing, and the testing should define for yourself basically not only the given entry idea, but also I would say like an event frequency, how often you are likely to hit your stop loss, how often is likely that the price move against your entry a set number of pips. Then you choose your sweet spot to be not too large a size, but not to get hit too often. You can, once you have the frequency of the events on statistically, you can come up with a number, and then make sure the position size after size to away that when that stop out happens, and it will happen eventually anyway, it's inescapable, then it's be a relative a low number that you can emotionally manage it, and is not gonna put you off balance, because it's very important that you can keep only to trade if you keep your relative upbeat, confident way to the market. If you're not confident that you are able to make money, you probably not gonna make money. You have to feel that when you place a trade, you have the probabilities on your side, knowing that you might not win, but you still have the probability, and it has to be a high probability, of course. Without that one, it's not gonna work. And with a too wide a stop loss, giving up too much of your account, uh, and I'm not talking about, like people reclassifying often the trade. I start a scalp trade, it goes against me, it's gonna become a day trade, it goes against me, it's gonna be a swing trade, and then I having it for 6 weeks open until it comes back. One of the things what we were not touching yet, basically, my trading is strictly, the scalping is strictly intraday. I go to sleep every day flat. That means for me emotionally is the safest one. I'm not gonna think about my trade when I'm sleeping. I am able to sleep in peace. So I end of the day when I go to bed, I make sure that I don't have any position open. I'm not reclassifying my trades to be a swing trade or whatever, also important to it, because it's very often that people like to deflect the taking that loss, and then is within the day it can also amount up for a certain percent, but it's no point to keep that and it's gonna come back eventually. Yes, probably it is, but if your money is tied up in that trade, you're not gonna probably take another one, and sometimes you lose more on those other opportunities not taking them, because you're sticking to that wrong trade, waiting for it or hoping for it or praying for it that it's gonna come back eventually. I say if it's
So
if
what
your
you do?
sorry, if I was
So
saying
what do
just
you do
if you
certain if you, for example, get caught in a flat market and the market just goes flat, you just get out?
if the market goes flat on me, like happened to me in that beginning of June, basically I was not done to my stop out. I take a stop on that one because because the market went flat. It was just going flat. I was going to I was tired. I wanted to be out of the market. I was waiting for it to reverse. It eventually did. So I wake up in the next morning and I saw I could come out and actually I could make profit on the trade. It was annoying because I was in with a more serious size of the lot size. But the point was that it was a minor cross, with already having Euro New Zealand already having a little bit wider spread to start with. And then the broker has not so many traders trading that pair, especially in the quiet times going into New York, the later New York session. The trade, there was no trading there. It was pretty much flat. Whenever I decide to close a part, I find myself with 1-2 pip slippage each time. Doesn't matter where I push the button, the price just jump in that second. That's simply how the broker software runs, because they're not gonna take a loss on it. The real market have even wider spread probably. There is, there is this marketing gig of the zero pip spread. In reality, that doesn't exist. So I take the loss,
No.
then I take the loss. I go to sleep flat. I don't want to hold the trade. I don't hold it overnight. I don't hold it over the weekend. The last time I was stuck with one trade, what I decided to hold, that was in 2019, in the beginning of May. From since that one, I never had an overnight trade open. The last
Wow,
one
that's
and a
remarkable,
half year.
because as you know, that's a big restriction, to say like I have to close everything in the evening. That's a big restriction. It makes it even harder to achieve a very high win-loss ratio. Let's be honest, no?
That's correct. But then again, the win-loss ratio of mine is not coming to having home runs, but it's having that I losing only 1 or 2 days during a year usually. typically I not lose too many times on my account because I relative trade small, so the gains are not gonna be a whole lot. But again, if I hit let's say 0.3% a day, if it average gain, then it's during a month is gonna add up for 6%, and during the year that's add up for a triple digit gain.
Yeah,
People
I
feel
mean, look, I
there
mean, I
that
think
they
it's
looking often to. That's okay.
maybe, yeah, I mean, look, I think the style is completely legit. Of course, if you want to play devil's advocate, people, the people would say, well, but you're taking very, very little profit as compared to, the potential downside. It's quite unbalanced. But
Uh,
look, the reality is, as long as you can, as you can really keep it up in terms of, like your selection of trades, and also being always more on the careful side in terms of risk. No, if you see, for example, okay, I entered here, now it's not going as I thought, so I will be extra careful, and I will consider whether I want to and how much I want to enter on the next one. I think the key in this strategy comes down to really, really hardcore risk management skills, and I hope that this podcast gave an insight into this to everyone watching. And that's also the one thing everybody should learn from you, this tight grip on the risk, because I loved it. You made this post, Zoltan, where you elaborated on that, and I really liked it. And I was like, look, this is the way to think, when you were writing, okay, here I took this risk. In the worst case, I would have down this percent. Here I took a hit, but I carefully recovered from that. Here I had a good run and I took a bit more risk. I think people should really study that and also try to imitate that a bit in their own trading, whatever they do. We are not saying, this is the only way to trade. Look, Zoltan, there are people who trade like, let's say risk reward systems, and they get whipsawed in between. And sometimes they catch a good move. It's also legit. We're not saying, this is not the way to trade. But the truth is, when it comes to risk management, no matter in which context, you need to have a tight grip on it. That's really, you need to be as good a risk manager as a trader. And that's what the industry doesn't tell you. The industry is obsessed with entries and indicators and useless approaches, and it doesn't put emphasis on, the necessary risk management. But let me also say, Zoltan, and that's what some people do not understand neither. Some people post, trading is all about discipline. No, that's not true neither. Discipline is not enough. And that's what you also realize when you test. You can have the best discipline, take all emotions out of the game, put a robot. It may implement exactly the rules, but often, most of the time, that doesn't lead to a winning system. So that's why it's so difficult, right? Because you need a combination of the good entries and exits, which makes sense, and risk management. The same, you need the combination of aggressive and conservative. Again, you need like a balance between two extremes. So this is what makes a trading game so complex and difficult. And I really love to talk to you here and to give some insight into how professionals actually think and work. And for me, and this approach for me, it's not gambling at all. It's the opposite, Sultan, because look, you're taking a quite defined risk, right? And like you say, look, you do your little trades, you do your little baskets. Most of the time, they work out fine, right? And then in the few cases where it goes against you, you are just hardcore sticking to your rules, isn't it, Zoltan? Can you try to describe that, like maybe about in more simple terms, like your mindset of this risk compared
yeah,
to returns?
basically, I would say, Jama, that still, you know, at one side I am prepared to have a basket of entries. That doesn't mean that I am not placing my first entry to be a winner. I don't like to run into a trade, often comes up, the word of the fear of. I don't really fear that much of missing out. I don't mind to stay until the right moment. I don't, as I said, for me it was critical to learn that I can be on the sideline, and the sideline in this case doesn't cost money. Think of like you go into the casino and you're playing blackjack. And even if you card
Yeah,
counting, you have to keep playing the game and you have to keep betting. Imagine Forex, You standing on a sideline, you counting your card, you waiting for your scenario to come up, but you don't have to pay, you don't have to bet. You can be right there and watch the market until it gives you the perfect deck is the hottest. How do you know the deck is the hottest? That's what your stuff you derive from your testing. So I always place my first trade to be a winner. Sometimes it's not the case. I also have an idea from the statistic how much I expect the price to be against me. I also try to enhance my opportunity that I go with the key levels or around key levels into the market and not that randomly. If the market is a middle of the day's range, I not try the direction. I try to fade certain things. If I do, I don't, I would say instead of being jack of all trades, I am trying to be the master of basically one way. I'm not trying to do breakout and fading. I do one thing. I doing short-term reversals. I try to predict the market on a short term. I'm not looking where it is in the monthly chart because it has nothing to do with me if I am trading intraday. The monthly really it's not coming into. I talk to some of the trading buddies, looking for monthly and weekly chart and then decide his scalp. I mean, how? I might look at the 15-minute chart sometimes for the hourly where the things are.
Yeah. If it's too far off the time frames, let's say minute chart and month charts, it's too far off. However, if you, for example, trade a 15-minute chart, it can actually be very relevant what the forward chart says. But yeah, I agree. If it's just intraday scalping for a few pips, I mean, whether the monthly chart is in a trend or high or low or breakout, I mean, come on, it doesn't seem to be relevant.
And Jamal, to continue on the thought, that basically I would say that maybe 60-70% of my entries are ending up actually, even though I'm ready to make them a basket if I need to, it's ending up to be a single entry. 60-70% of the time I'm right spot on. And I would say the rest of the times, again, statistics gonna tell you that that how much is the distance the price can go against you, and you can divide up your entry points. And one of the thing I often use that I look at the next significant level maybe I am interested in and see how far that is. And if it's too far away, then maybe I expect the price not to get too extended there in one go. Or if it's not too far, then maybe I divide up my basket to be placed within that distance. So I am actually covering that distance in case if the price extends to that, really expecting to go a lot further. Once again, like a ADR. ADR is not gonna tell you that the price reached 100%. ADR is not gonna go further. That's a silly idea to think, but it's gonna give you a ballpark number on a typical day how far you go. And if you are already seeing that you already passed there, especially with a healthy percentage, and you're hitting some important level, you can expect that the price on the day maybe not gonna extend a lot further. Then I can place my basket accordingly. I still find that that the statistic gonna give you some good ballpark numbers. And then if you can let's say if you can gain 15-20% before you hit one time a 10% or an 8% stop out, then you're still going forward in direction. And that's only the matter. The rest of them, let it play out. And don't get scared in case if you get 2 times hit with a stop out in a relative short period. It doesn't mean that necessarily you're doing something wrong. Believe, you have to believe on your statistics. Otherwise, you're going to hope on for a next system and the next system. And it's not going to, you have probably the winning approach. But if you keep tweaking it too much, then it doesn't have a chance to work out for you to be a winning approach.
But when it comes to those normal losers, Zoltan, so let's say those 23% of normal losers, did you ever look at what's the average loss compared to the average win? Because, for example, if you're just taking a few pips, do the losers are they like twice of that or 3 times of that, or what's roughly the relationship?
I would say, it's a little bit difficult because as a set, I looking at them as a set. Maybe the part of the set is losing. Let's say I have a scout trade and I have a second trade and maybe I have a third trade. But if the size is not fully equal, I don't need to go back until the scout entry to be break even to actually make profit. Even I might not even need to go back halfway to make a profit. Depend how my sizing was. This is where I often say that I don't mind the pips. The pips itself doesn't matter. Maybe one entry lose 15 pips and the other maybe make 7 pips, but the 7 pips can make up for the 15 loss. I ending up maybe with a negative pip with a positive dollar. And as per a setup, I would say if you sizing yourself carefully, not going too heavy too early, and you done your homework on the statistic, you can get way over 90% of the setup to be a winner.
Yeah, for sure. I mean, that's what
I would say most, and it really sounds crazy, but you could get most of your setup probably out as to be a winner. Most of them. It's only different that if you go too aggressively. But then once again, if you want a high return, then it's gonna come at the cost of high risk. So it's no way around. It's no way around. If you're happy
maybe
with
that's a good way to. Maybe that's how we can conclude this podcast. No, I mean, obviously that's the case. No, I mean, if you want to achieve those really good numbers, around 100% a year, of course, that's the implication. No, I mean, there's no free lunch in that sense.
Yeah.
But look, I mean, Zoltan, thank you so much. That was really, really good. I mean, we definitely have to do another one maybe in the next weeks or so. Let's try to find another day where we can do another podcast to discuss some more topics. But thank you so much, Zoltan, because that was really, really good, really great insight. It's fantastic, that we have this little group of traders and they are all willing to explain a bit to the others who also want to go that way. And we need to do that, Zoltan, also to counter all those fake traders on Instagram and Facebook and whatnot with the Lamborghinis and the dollar signs and all this BS, all these liars who never traded in their lives, so talking all this stuff and putting these expectations in that. I love to counter that, by showing people the reality, by giving people an insight, into the mind of people who are actually professional, proven traders, not like Instagram people looking to introduce clients to any kind of brokers or companies or whatever. So, and this is really great insight on the highest level. Maybe next time, Zoltan, we can even show some screenshots or something, or give some examples to give people a bit better idea as well, because some of the things we just talked about were maybe a bit complex as well, especially for beginning traders.
Maybe next time I'm gonna look up some
that will be fantastic. And apologies.
And there is a few more. There is a few more things, yes, definitely, what we left out, like in position sizing and such, and yeah, definitely. It was a pleasure to talk, Jamaya.
Yes, thank you. Apologies for the audio. We had a bit of a lag. I tried to correct this a bit, maybe in the editing. Sorry, we had a bit of a time lag. And also sorry that sometimes maybe we jumped a bit. But as you can see, when we talk about one thing, Sultan, other topics open up, and then, of course, it's also relevant to cover those. So anyway, Sultan, again, thank you so much for your time. Please, let's do another one at least, or maybe one or two in the next weeks when we both have time. And, again, on a weekend, maybe we find that time to sit together and discuss those topics. That's really, really appreciated. Final words from your side, Zoltan. Any other thing you wanted to say or advice for beginning traders? What would you say to them?
I definitely, if one final advice is try not to overcomplicate. Try not to overcomplicate. Try to find some relative simple basic idea and try to just fine tune that a little bit, but without overcomplicating too much. If a system has more than two indicators, probably it's overcomplicating. and try to not hop from one idea to another one, not to give up too early on it before you have a chance to find out that what is actually it's capable or not capable to make. Very often people discard a good thing just because, I don't know, early on maybe get a losing trade and then suddenly it's not good.
For sure, that's very good advice, Sultan. All right, thank you so much. Have a great night. It's it was longer in the end than we thought.
Indeed. We're gonna continue. Thank you very much, Jama. Happy weekend. Bye
Thank you,
bye.
Sultan. Bye. See you soon.